Tax season seems like it's always right around the corner, and a lot of our investors, builders, developers, house flippers utilize a tax strategy called a self-directed IRA. I was able to speak with Martin Campbell from Equity Trust Company in regards to why so many of our clients utilize his company. Not only to reduce their tax liability, but how to set themselves up for retirement as they continue to invest in real estate. Have a listen.
Any individual that pays taxes on their earned income can utilize the self-directed IRA. Yeah. Also, anybody that maybe has a retirement account currently can potentially utilize this. Now, we'll get into the details around that. So, individuals that have left their employer can move their employer plan over to an IRA and then self-direct. Individuals that have an IRA currently can transition a portion of full amount of that IRA to a similar IRA here at Equity Trust and self-direct. And then on the employer plan side as well, let's say I'm working at Equity Trust and I'm closer to 59 and a half, but I'm still working at Equity Trust. I can now take that retirement account as my 401k and now move it over as an in-service rollover or direct rollover. So again, I couldn't move my 401k if I'm like in my 40s or 50s. But once I get closer to the retirement age of 59 and a half or over, companies will give some concessions allowing them to move over, if that makes sense.
Yeah, because I know my company, for instance, right now, like I can't move mine. I have to keep my 401k. They won't let me withdraw it or move it or do nothing with it. Correct. So that's a good point. So if you have one, you're getting close to retirement, or a lot of these guys have, SEP IRAs, self-employed IRAs, and from that self-employed, they would move it to you to a self-directed. Is that correct?
They would, yeah. And if they're still contributing to a SEP IRA, they can have a SEP IRA here at Equity Trust. If they're not currently contributing to a SEP IRA, but they still have a SEP, they can now transition that SEP IRA to a traditional IRA because it's just a similar tax environment, if that makes sense as well.
Right. So let's run an example here so people can understand. Let's just say, for instance, income earner, let's just give some hypotheticals here. Let's say $300,000 is what they made. Let's just say some of the stuff with short-term capital gains, maybe they had a high gain and they got to pay, let's just say for round numbers, they have to pay $100,000 in taxes, right? That is their tax liability they got to pay. Why would they come to Equity Trust, and what percentage of that $100,000 could they potentially invest to themselves? Because again, the idea of Equity Trust Company, or especially for self-employed people, is to create their own retirement.
Sure.
Right?
Yeah. So let's talk two fronts, right? Let's say that $300,000 is currently in a SEP IRA. They can now bring that $300,000 over into a SEP IRA with Equity Trust and self-direct into alternative type assets. So they can purchase real estate, they can purchase mortgage notes, they can be a private lender, invest into private companies, digital currency, precious metals, tax liens, tax deeds. Just think of investments outside of the stock market.
Right.
Now, they have $300,000 that they can now think differently about retirement investing going forward. Now, let's say somebody is making $300,000 and they're self-employed, but they don't have a current retirement account, right? They don't have a SEP IRA, right? They only have the ability to put up to $69,000 as a contribution into their SEP IRA. So it's 0 to 25% of their salary can go into a SEP IRA. So again, they just can't exceed the contribution limit every year. But the good thing about having any money in an IRA is there's certain strategies called partnering, Mike, where individuals maybe don't have enough money in their retirement account to maybe purchase real estate. I'll just use real estate as an example.
Yeah.
So let's say I have $69,000 in a SEP IRA. Now I can find another funding source to purchase the property with. So let's say a spouse or a sibling, a financial partner, a financial friend has maybe the additional $231,000 in a retirement account. Now there can be two titles on that property. My IRA can partner with another IRA, like a family friend, financial individual, or spouse, or my IRA can partner with non-IRA money. So my own personal cash like an LLC, or somebody else's personal or business cash like an LLC.
Right.
Now what happens is two people are just holding hands together on one investment deal. So I see a lot of clients that do that on real estate.
Yeah.
I see a lot of the clients that do that as a fractionalized loan to a company or an individual. So each percentage owner is on the deal at a certain percentage. Now, let me just stretch this out a little bit.
Yeah.
Let's say I'm doing a deal with like a spouse, right? And let's say on $100,000 property, I bring 30% to the table. My wife brings 70% to the table. Because we're related, any purchase, earnest money deposit, expense, and profit has to ebb and flow from two funding sources based on our 30-70 percentage. Does that make sense?
Right.
Now, let's say, Mike, you and I do a deal together, right?
Yeah.
We're not related in any capacity. You and I could bring 90% to the table, 80% to the table. You could bring 10 or 20% to the table. And now we can Christmas wrap this in a joint venture structure, and we can split the profits unevenly if we want to. It doesn't have to meet the 80-20 rule or the 90-10 rule if we're related. So if I'm doing a deal with my spouse, my parents, my grandparents, my children, any of their spouses, any grandchildren, and any of their spouses, everything has to be proportionate because we're up and down lineal descent. Does that make sense?
That makes sense. Okay.
But if you and I are doing a deal together, we're not related in any capacity. So we can go to an attorney, draft a joint venture agreement, and we can split the profits. The profits don't have to meet proportionate percentage of interest of percentage on title. Does that make sense?
Very interesting. Okay, very interesting. Great point. Glad you brought that up.
So
okay,
so a lot of people that have a small balance IRA, they may look to do a joint venture structure because maybe it catapults their IRA on their first investment. They just have to find that financial friend that has the lion's share of the money, if that makes sense.
And so every year or right now, it's $69,000 no matter what you make?
Correct. Yeah, that's the contribution limit, $69,000.
So let me ask you, this is another question too, because it seems like there's not a lot of tax preparers, CPAs, whatever you want, tax attorneys, whatever, that know about these vehicles like that, right? Because I don't know if they don't know because they don't care or because they just don't flat out know. But from my experience, it seems like a lot of tax people are not familiar with this. Therefore, the clients, my friends and family, let's say, aren't getting advised of this. Like I said, when I have conversations, I'm the one that brings this stuff up, and then some reach out or whatnot. You know, what's your comment to that? What's your recommendation to that? Do they if they engage their tax person and it's like, well, you know, we don't set that up, we're not familiar with that. Obviously, they reach out to you. Do they need to find a different tax person, or is that just pretty common that you see?
No, it's very common. So I have some friends that are CPAs and accountants. They're very good at getting their clients' tax deductions, right? They're not looking to grow their client's account. They're looking to reduce their taxable liability, if that makes sense.
Yep.
Right? Where equity trust comes into play is those individuals that say, hey, I have a CPA that's reducing my taxable liability, but now I can move a portion of my retirement account out to equity trust and think differently about retirement investing. So if I ask my financial friends, CPAs, about like investing into real estate or mortgage notes, they don't know that, right? They're a CPA, they're preparing taxes, they're getting their clients' tax deductions. So, you know, it's just what CPAs or accountants do. They don't live in an investment world. They live in more of the preparing documents and getting their clients the most amount of tax deductions possibly at most possible under the IRS regulations, if that makes sense.
Right. Yeah, perfect. So like I said, I got builders, investors that use this. Some of them will use, you know, half out of their IRA, half the money out of their personal. Build homes with it, they'll buy rental properties, they'll lend money out of it. So let me ask you this. Let's just say I got $500,000 in my self-directed. And I want to, and if I want to pull that money, whether I purchase a property or whether I lend the money, let's just say out of $500,000, I pull $100,000 out. Do not pull it out, obviously. Invest it because Equity trust company on the grant deeds, it's the for benefit of, equity trust company is the one that takes title for benefit of Michael V. Aries, let's say, right? So if everybody understands
Correct.
that. So if I purchase, let's just say a home for $100,000, I have $500,000 in my account, $100,000 for that home. If I took out that $100,000 to purchase something, do I have to pay anything? Is there fees or a monthly interest that I have to pay since that money came out of my account?
Sure. So if you're moving your retirement account over to Equity Trust, there's no taxes or penalties incurred, as all you're doing is you're selling a stock, mutual fund, or each ETF in the account to prepare for the transfer of cash to Equity Trust. So you're not incurring any taxes or penalties as long as it's in an IRA, past employer, or you're over the age of 59 and a half with a current employer. Does that make sense?
Yeah.
Now, we do charge a fee based on balance here at Equity Trust. So any balances between the realm of $100,000 and $1 shy of $250,000, we charge $987.50. So our standard annual maintenance fee, Mike,
Monthly?
is annually.
Annual.
Yeah. So our standard annual maintenance fee for that amount is $750. The reason it's a little bit more is we just don't think it's fair to charge you $750 now and $750 at the turn of the first of the year. So we're doing $187.50 prorated for the remainder of this year, $750 for all of next year, and then a one-time $50 setup fee. So January of 2026, any balance that's between $100,000 and $1 shy of $250,000, $750 would be our annual maintenance fee. And that covers everything within the account, all standard income and transactions, all record keeping reporting, all bill pays and deposits. The only additional fees that your potential people will see, Mike, is, let's say somebody calls me and says, listen, Marty, I don't want Marty the mailman handling a $200,000 check. I want to wire these funds directly to my investment. We charge $30 for a wire, which is pretty standard in the industry. If you're potential clients that call me and say, hey, Marty, listen, the investment paperwork I sent to Equity Trust, that's got to be in a rush. I need that to be done and completed by end of business day today or tomorrow. Then it's $75 to do a rush, as we process transactions within 3 to 5 days. But if they do everything, I always make the analogy. If you see that the FedEx and UPS planes in the air, that's our $30 or $75 wire certificate. Right. If you see those trucks on the ground, that's just our annual maintenance fee, if that makes sense.
Right, that makes sense. Okay. Yeah, so because for some reason I was under the impression that if that money was out of your account, you'd be paying interest on it or something, but there's nothing like that.
Yeah, well, when your money just sits here as cash, it collects less than 0.5% interest. We do have the universal IRA model, where clients will get 50 commission-free trades within brokerage. So if they want to do brokerage here, they can. They just would have to open an application for a brokerage department. And then we have thousands of ETFs, mutual funds, and index funds that our transaction is free as well. So I tell clients, if you want to keep your money as cash, you can definitely do that. You can also do that at your local bank. So you always have the opportunity to keep your money working for you if you so choose.
Yeah. And then real fast on the Equity Trust, I mean, what kind of track record, how long they've been around? Who the hell are you guys? So for the viewers.
Sure. Yeah, great question. So we're still a family-owned and operated company by the Dessage family. Dick Dessage had founded the company about 50 years ago. He bought a drug mart. It's like a local, like Walgreens in your area, Rite Aid. It's just a discount drug mart here in the Cleveland, Ohio area. And he did a triple net lease. So he found out that retirement accounts could be used differently. So he pulled his money with a couple other investors, and that's how the company was founded about 50 years ago. We now have over $50 billion in assets under management. We have about 450,000 clients, and we just have shy of about 500 or 400 people that work in the organization. Now, we're a custodian. So what a custodian means is that Equity Trust is permitted to hold alternative investments because we're a custodian. That's why you don't see a Fidelity, Vanguard, TD Ameritrade hold these type of investments going forward. Now, our company is domiciled in South Dakota. We're a state chartered organization, but most of the representatives are here in Cleveland, Ohio. And if you look at any custodian, you go up a road and there's all the custodians and domiciled there because South Dakota gives favorable trust laws to companies like ours.
Yeah, like I said, my friends and family have been using you guys for years. And I know there's other companies out there too, I know. But like I said, you're the one, and like I said, to deal with you guys even on the escrow and title side. I mean, getting as a third party for you guys, trying to get somebody to sign, a document, the grant deed when you're buying or selling, and the wires and all that stuff. I mean, everybody that I've dealt with that has dealt with you guys purchasing or selling from their IRA has had, virtually no complaints. I mean, it's not like it's a big old fuss to do it. And like I said, the main thing I wanted to get on here too is because people just don't know. They go into these tax.
Sure.
They got these realtors, these investors that are paying hundreds of thousands of dollars in taxes and just don't know about this vehicle that they could have put, over especially the last 4 years, this crazy market we've had. They could have put, hundreds of thousands of dollars away, literally, even in the last decade. So they're missing out, and that's really why I wanted them to get a face on here. And I appreciate your time for coming on here. I know you're a little bit under the weather, you said, and I'll put your contact information. It's okay for people to reach out to you via email or phone or.
Yeah, just let them know that you referred them to myself. But if you want to copy me on an email, soft introduction, if you want to just provide my contact information to them, I can take them to the journey. And again, I am a bit under the weather, so I do apologize. But again, just think, I have 3 Roth IRAs throughout the country. I have one at American Funds, one at Morgan Stanley, and then I have one at Equity Trust. So what I can do at Equity Trust, Morgan Stanley and American Funds can't do for me. What Morgan Stanley and American Funds do for me is I have financial advisors over there. So now what I'm doing is I'm just shifting money back and forth as I see fit. So when I have investments here at Equity Trust and I get profits back in, maybe I don't have another investment. Maybe I don't want to do a stock here at Equity Trust because I'm not well versed in stocks. So I'll transition that money back over to American Funds or Morgan Stanley because I have financial advisors that do for me what I can't do. But when I want to move money from Morgan Stanley or American Funds, I just tell them, hey, please send money over to Equity Trust because I have another investment. So now I have multiple investments between 3 companies that are working for myself and my family. That makes sense. So all funds don't have to be in one bucket of money or IRA. I could have 100 different Roth IRAs at 100 different companies. May not make sense because I'm now paying fees for hundreds of companies. I've limited it to 3 because they're doing for me what I want them to do.
Right.
I'm just doing what I do at Equity Trust because I've educated myself in regards to investments that maybe I can now self-direct that makes best sense for me to diversify my retirement account so I can get the most amount of passive income as possible.
Yeah, so when people reach out to you, I mean, you could advise them on different scenarios like that too as well, right?
I could. We're not able to provide legal, tax, or investment advice. So if your clients come to me and says, hey, Marty, I want to purchase real estate, I'll ask some underlining questions like, what's the price of the property? What's your intended strategy? Are you renting it out? Are you buying land? Are you flipping the property? Are you loaning money out of your IRA? Then I just want to know kind of where the money's coming from, what the price of the investment is. Now I can start putting the pieces of the puzzle together. So in regards to real estate, let's take, for example, right? Let's say I'm buying a property 100% with my retirement account. So number one, none of that income hits my 1040 until I take a distribution at the age of 59.5 or 73 when it's required as a minimum distribution. Number two, let's say I'm flipping it or renting it out. I don't have to report any Schedule E or Schedule C. Do you know what that is, Mike? Obviously. Yeah. You avoid recaptured depreciation. And then the biggest thing is the capital gains taxes, right? So if I sell a property less than only in a year, now my short-term capital gains tax rate in this country is my federal effective tax rate. Within the IRA, I avoid that, right? If I sell the property longer than owning it a year, now my long-term capital gains tax rate a little bit more favorable, between 15 and 20%. So I had a guy the other day that said to me, he says, I'm sorry, a guy back in 2017 when I started with the company, he called me the other day and he said to me, he says, "Hey, Marty, this strategy works for me. I appreciate it." And I said, "No bother." He bought a property here in the area somewhere, and I forget what the price is, but he said it's a ride. I think you remember it was around $100,000. He said, "Marty, my expenses on this property are about 4% annually, but I have a tenant that is paying me $1,000 every month. So $12,000 minus $4,000 is $8,000. So every year in his retirement account, as long as he has this renter in there, he's collecting $8,000. Now, he told me he's going to hold this property for the rest of his life if he can.
Yeah.
So it's just passive income coming back into his retirement account. So he's just pulling that money out as he sees fit. He's just supplementing his retirement account with real estate investments as opposed to stocks, bonds, and mutual funds, if that makes sense.
Yeah, I mean, you mentioned it already too, but again, let's reiterate that 59.5 or 72, you said?
Yeah, so at 50, so people that have a pre-tax retirement account, like a traditional IRA or a SEP IRA, at the age of 59 and a half, they're able to pull money out of their retirement account and put it in their pocket. Now that money is going to hit their 1040 as ordinary income, and they're going to have to pay taxes on that. So let's say I'm 59 and a half. Let's say I don't want to pull any money out of my retirement account. I don't have to. I just have the ability to do that at 59 and a half. But what our wonderful government has said is that at the age of 73, Marty, we haven't gotten any taxes from you, right?
Yeah, right.
So now at 73, you're required to pull a minimum out, kind of going forward. So there's just an algorithm that's run that you just, so if you have any pre-tax retirement account, let's say I have a traditional or a SEP IRA at Morgan Stanley, I have one at American Funds, and I have a real estate property at Equity Trust. Let's say I have cash at Morgan Stanley and I have cash at American Funds. I don't have to distribute the asset that I have held at Equity Trust because the RMD is on the totality of the pre-tax retirement accounts I have at 73. Does that make sense? So I would just pull the cash out instead of taking the distribution of the asset.
Interesting. Yeah, it's good stuff, man.
Yeah. And then one other thing I'll tell you is a strategy that some clients are doing, and I'll just mention it, but it's a huge benefit. So some clients, when they get into their later years, like let's say I'm 60 years old, right? Or 65, or even 60, 68, right? What I can do if I have a pre-tax retirement account, Mike, I can start looking at converting that pre-tax retirement account over to a Roth IRA. So it's called a conversion. So I convert, let's say I take 100 grand of my pre-tax I don't have a traditional IRA, but let's say I did. Let's say I want to take $100,000 now, near the age of 50. And let's say I want to convert the 100,000 from my pre-tax retirement account to my Roth IRA. $100,000 would get added to my 1040 as my ordinary income. And I'd have to pay taxes based on whatever my federal effective tax rate is. Let's just say it's 30%, right? I'm paying $30,000 on those taxes, right?
Yep.
But now let's say I make a real estate investment with that Roth IRA, or I convert a property over to a Roth IRA. Now the gains, as long as that Roth IRA is open in season for 5 years, I don't pay any taxes on any of my profits, right? Because it's a post-tax retirement account. So what a lot of clients will do is sit down with their CPA or accountant and say, hey, if I convert this money over, what's going to be my gain? A client here at Equity Trust has $1 million in his account. He's converting $100,000 every year. He doesn't want to take the $1 million tax hit. He wants to take the $100,000 tax hit. And now what happens? He doesn't need the money. He's fortunate he doesn't need the money, but he wants to leave the money to 2 of his grandchildren. So now what happens when he passes away? He's going to continue to build that account up with real estate private loans, alternative investments. But when he passes away, now he leaves that as an inherited IRA to his grandkids. They're not burdened with taxes.
Mm.
So they can just pull it out tax free. So if you look at clients that are selling properties, if I bought a property for 100 grand and now 10 years later, now it appreciates to like 250, let's say, I sell the property, the $150,000 of gain is never taxed because that's in a Roth IRA now.
Wow, that's awesome.
So you get some
trust fund baby, right?
Yeah, you get some legacy. Yeah, I wish, right? So, so now you get some legacy and estate planning. You don't the Roth IRA avoids RMDs. So the Roth IRA is a tremendous vehicle if you're looking at post-tax dollars. So now you're just investing. Government has their hand out and says, hey, we need taxes. You can say, I can say, I don't owe you any taxes because, all of my stuff is currently in a Roth IRA.
All right, man, that's awesome. Holy smokes. Well, I think you'll be getting some calls for sure. I think the people will be reaching out for you. Just like I said, I'll definitely put your contact information out there, man. Thanks for your time.
Yeah.
Any last thoughts?
No worries. Just send my information out. Look, make sure they tell me where they heard my name from, and again, I'll help accordingly. I've been doing this for about 8 years at Equity Trust. Started back in 2017. So I was trained by my national education speaker. His name's John Bowens. What your clients can do is there's a website that we have. It's Trust, TRUST, and then the initials ETC for Equity Trust Company. So it looks like trustetcetera.com. Your clients can go on there. Your people can go on there if they want information. I would highly encourage people to also go to our YouTube channel as well and subscribe. But again, if anybody calls you from Equity Trust, just let them know you're working with Marty Campbell. And again, I'll be a single point of contact for any and everybody.
Awesome. I appreciate it, man. Thanks for your time.
No problem. And again, apologize, I'm under the weather, but thanks for taking the call.
Yeah, sounds good, man. Thanks for your time.
All right. Have a good day.
You too. Bye.
Bye-bye.